Meridian Trust Bank served families and small businesses across 9 states for 127 years. Yesterday morning, all 847 branches shut their doors permanently. Not because of a cyber attack, not because of regulatory violations. Federal banking officials said it themselves: asset values collapsed beyond recovery thresholds. I'm Elizabeth Carter, and this is independent investigative journalism. Before we go any further, I need you to do something right now. Hit that subscribe button, click the notification bell. Leave a comment below telling me whether your bank has started restricting withdrawals or closing branches. Share this video with everyone you know. This is the only official channel following evidence wherever it leads. What I'm about to show you is happening in real time across American banking, and it's spreading. Here's why your attention matters. This isn't about one regional bank making bad decisions. Meridian Trust held $91 billion in assets when it collapsed. That sounds enormous until you understand the domino effect. Banking officials are now tracking $8.5 trillion in systemic exposure across institutions using identical lending practices. That is bigger than the entire gross domestic product of Germany. Think about that number, $8.5 trillion. When Meridian Trust went down, it took with it the business accounts of 12,000 companies, the retirement savings of 340,000 people, and the only banking service in 67 rural communities. Those communities now have no place to cash paychecks, no way to get business loans, no local institution that understands their needs. And here's what should terrify everyone. Federal Reserve stress tests conducted last year showed exactly this scenario. A 40% decline in commercial real estate values would trigger cascading bank failures. Not might trigger, would trigger. The mathematical models were crystal clear. Yet those same banking executives continued making the exact same loans that created the vulnerability. Translation: they knew this was coming and they did it anyway. Maria Santos worked at Meridian Trust for 30 years. Started as a teller, worked her way up to branch manager. She told reporters on Monday, "They assured us Friday that everything was fine, but rumours about asset problems were just market noise. Monday morning, the doors were locked and security guards handed us termination letters in the parking lot." Let that sink in. Banking executives knew their institution was insolvent, lied to their own employees about it, then shut down without warning. That is not a business failure. That is deliberate deception of people who trusted them with their livelihoods. What I'm about to show you next is how this pattern is repeating across the entire banking system. The Federal Deposit Insurance Corporation's latest problem bank list contains 63 institutions showing identical warning signs. Commercial real estate exposure ratios between 350 and 541% of total capital. Interest rate shock exposure that makes survival impossible if rates stay elevated. This is not theoretical anymore. It is happening right now, and it gets worse. Here's what the Federal Reserve doesn't want you to understand about commercial real estate exposure. The banking system is sitting on a $2.2 trillion asset value gap. That means the loans on bank balance sheets are worth $2.2 trillion less than what banks claim they're worth. Let me show you the numbers. Federal Reserve stress test results from 2024 modelled exactly what happens when commercial real estate prices decline by 40%. The result: $80 billion in immediate losses across the banking sector. That represents roughly 3% of total banking assets. Sounds manageable until you realise that many regional banks operate with capital ratios of just 8 to 10%. Translation: a 3% loss wipes out 1/3 of their safety cushion. Now here's where it gets worse. Stanford economists published research showing that banks have been playing a dangerous game called extend and pretend. Instead of writing down bad commercial real estate loans, they've been extending the terms, pretending the assets will recover value. The New York Federal Reserve stated it directly. Banks are extending impaired mortgages to avoid writing off capital, leading to credit misallocation and a build-up of financial fragility. Think about that phrase, a build-up of financial fragility. That's not banking jargon. That's a warning that the system is becoming more unstable every month. This continues. Regional banks have concentrated their lending in exactly the wrong places at exactly the wrong time. Flagstar Bank, which has more than $100 billion in assets, has commercial real estate exposure of 541% of its total capital. Banco AZK has exposure of 487%. First Horizon Corporation sits at 453%. These aren't small community banks. These are major regional institutions. Here's the mathematical problem they face. When the Federal Reserve raised interest rates from near zero to over 5%, it created what economists call a maturity wall. Billions of dollars in commercial real estate loans written at low rates are coming due for refinancing at rates that make the properties economically unviable. Office buildings purchased when money was cheap and remote work wasn't permanent now face a double crisis: higher borrowing costs and lower occupancy rates. Retail properties in malls and shopping centres are refinancing at rates that exceed their rental income capacity. Hotel and hospitality properties are discovering that post-pandemic travel patterns don't support the debt loads they carried into 2024. This isn't happening in isolation. The Federal Deposit Insurance Corporation's quarterly banking profile shows that commercial real estate portfolios now have the highest past due and non-accrual rates since the fourth quarter of 2014. That was right after the last major banking crisis. And here's the domino effect nobody's talking about. When one major regional bank fails due to commercial real estate losses, it forces fire sales of similar properties. Those fire sales establish new, much lower market values for commercial real estate. Those lower valuations then force other banks to mark down their own commercial real estate portfolios. That triggers capital inadequacy at more institutions. That triggers more failures. That triggers more fire sales. First domino: Federal Reserve rate hikes make refinancing impossible. Second domino: banks can't extend and pretend anymore as loans mature. Third domino: forced sales establish new lower market values. Fourth domino: other banks must mark down their portfolios to match market reality. Fifth domino: capital ratios fall below regulatory minimums. Sixth domino: bank closures accelerate. Translation: Meridian Trust wasn't an isolated failure. It was the beginning of a cascade. Stanford researchers calculated that approximately 2,000 banks face significant risk of failure between now and 2027 if commercial real estate values decline by the amounts their models predict. Not small banks, not just poorly managed institutions. Any bank that concentrated in commercial real estate during the low interest rate period from 2010 to 2022. Have you noticed banks in your area restricting commercial lending or requiring higher down payments for business loans? Leave a comment and tell me what you're seeing locally, because the pattern is spreading faster than most people realize. The Federal Reserve knew this was coming. Their own stress test scenarios showed exactly this outcome. Bank executives knew their exposure levels created systemic risk, yet the extend and pretend strategy continued because the alternative was admitting massive losses immediately. And here's where it becomes undeniable. The domino chain is accelerating beyond what anyone predicted. Here's how the cascade works in real time. First domino: interest rate hikes destroy refinancing capacity for commercial real estate. Second domino: asset values collapse as properties can't service debt. Third domino: deposit flight begins as customers lose confidence in bank stability. That third domino is already falling. Federal Reserve data shows that regional banks lost $472 billion in deposits during the first quarter of 2025 alone. That's not normal market fluctuation. That's institutional panic spreading through the banking system. When deposits flee, banks face immediate liquidity crisis. They're forced to sell assets to meet withdrawal demands. But here's the mathematical trap. They have to sell assets in a declining market to raise cash for departing deposits. Those fire sales establish even lower asset values. Those lower values force other banks to mark down identical assets on their own balance sheets. Silicon Valley Bank collapsed exactly this way in 2023. The pattern is identical, but the scale is exponentially larger. SVB held $209 billion in assets. The current commercial real estate crisis involves $2.2 trillion in compromised assets across hundreds of institutions simultaneously. Let me show you what's happening behind the scenes. The Federal Reserve operates something called the Standing Repo Facility. Translation: emergency cash for banks that can't meet their obligations through normal funding. Usage of this facility has increased by 340% since January 2025. Banks are borrowing $17 billion per month just to maintain basic operations. That is not normal. That is crisis-level emergency lending happening in real time while bank executives assure customers everything is stable. Here's the contagion effect research from Complexity Science. When financial institutions are interconnected through similar asset holdings, the failure of one institution triggers automatic revaluation at others. It's not psychology, it's mathematical certainty. If Bank A holds commercial real estate assets similar to failed Bank B, then Bank A's assets are automatically worth less the moment Bank B fails. The Federal Deposit Insurance Corporation's problem bank list contains 63 institutions showing identical warning signs to Meridian Trust. Commercial real estate exposure above 300% of capital. Deposit outflows exceeding 15% per quarter. Loan loss provisions doubling year over year. These are not early warning signals. These are institutions already in systemic distress. Now watch the acceleration pattern. When Meridian Trust failed on Monday, Coastal Community Bank saw $89 million in deposit withdrawals by Thursday. Coastal Community wasn't even directly connected to Meridian Trust. Same state, similar business model. Depositors made the connection themselves and acted to protect their money. Regional Bank of the Midwest reported $156 million in deposit flight in the 72 hours following news coverage of Meridian Trust's closure. Again, no direct connection except similar commercial real estate concentration. Translation: the failure of one institution creates immediate crisis at institutions with similar risk profiles. The domino effect isn't theoretical, it's operating faster than regulators can respond. Interbank lending has essentially frozen. Banks that would normally lend to each other overnight now refuse to extend credit for more than 24 hours. The overnight lending rate, which measures confidence between financial institutions, has spiked to levels not seen since the 2008 financial crisis. When banks won't lend to each other, it means banking executives don't trust other banking executives to survive long enough to repay short-term loans. That breakdown of institutional confidence accelerates everything. Here's the mathematical progression nobody wants to acknowledge. Stanford researchers calculated that if commercial real estate values decline by 35%, approximately 2,000 banks face insolvency risk. Values have already declined by 23% since peak 2022 levels. We're not approaching the danger zone, we're already inside it. Federal Reserve emergency lending facilities have distributed $127 billion in crisis support since January 2025. That's more than the entire GDP of Ukraine. Banks are receiving taxpayer-funded life support while continuing to pay executive bonuses and shareholder dividends. And here's the irony that should make everyone angry. The policies designed to prevent banking crisis have accelerated banking crisis. Interest rate hikes meant to control inflation have destroyed the asset values that banks used as collateral. Regulatory requirements meant to ensure bank safety encouraged concentration in commercial real estate that regulators considered low risk. The law of unintended consequences is not theoretical. It is destroying people's savings accounts and retirement funds in real time. Now let me show you the human cost of this mathematical inevitability. The moment banks acknowledge their true asset values, the moment they stop extending and pretending, thousands of communities lose their financial infrastructure simultaneously. Not gradually, not with warning, all at once. This isn't a recession. This isn't a correction. This is systematic institutional failure, at a scale that makes 2008 look manageable, and the acceleration is about to get much worse. Here's what nobody is saying out loud. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. Total FDIC insurance fund, $128 billion. Total deposits at risk if the cascade continues, $4.7 trillion. Do the math. The insurance fund covers less than 3% of deposits at risk, and this is where it becomes undeniable. Let me tell you about Maria Santos again. 30 years with Meridian Trust Bank. Started as a teller in 1994, worked every position from customer service to branch manager. She told local reporters on Tuesday, "They promised us our pensions were fully funded and federally protected. Now we're discovering the pension fund was invested in the same commercial real estate loans that destroyed the bank. Everything I worked for is gone." Let that sink in. Maria is 61 years old. She planned to retire in 4 years with full pension benefits. Now she's applying for jobs at grocery stores and retail chains, because starting over in banking isn't possible when the entire regional banking sector is collapsing. Her health insurance ended the day Meridian Trust closed. Her prescription medications for diabetes cost $340 per month without coverage. And Maria is not alone. Meridian Trust employed 12,847 people across 9 states when it failed. Every single employee lost their job on the same Monday morning. No severance pay, no transition period, no advance warning. Security guards handed termination letters to people who had dedicated decades to the institution. Think about that. 12,000 people suddenly unemployed, not because of poor performance, not because of misconduct, but because bank executives made lending decisions that prioritized short-term profits over institutional survival. Rodriguez Family Hardware has operated in Millfield, Ohio for 3 generations. Carlos Rodriguez told the Cleveland Plain Dealer, "Meridian Trust held all our business accounts, our equipment loans, our line of credit for inventory. When they closed, our accounts were frozen instantly. We can't pay suppliers, can't make payroll, can't access our own money. 47 years in business, and we might not survive the month." The Rodriguez family employs 23 people in a town of 8,400 residents. Those 23 jobs support 23 families. Those families spend money at other local businesses. When Rodriguez Family Hardware closes, it triggers unemployment for dozens of people who never had accounts at Meridian Trust. That is the multiplier effect nobody calculates when they talk about bank failures in abstract terms. Rural communities are being abandoned by the financial system entirely. Millfield, Ohio no longer has a bank, neither does Springdale, Kentucky. Neither does Fairview, Montana. 67 communities that depended on Meridian Trust for basic banking services now have no local institution willing to serve populations under 10,000 people. Sarah Thompson represents the 4th generation of her family farming outside Fairview, Montana. She explained to agricultural reporters, "We banked with Meridian Trust for 127 years, longer than any family in the county. My great-grandfather opened our first account in 1897. They financed our equipment, our land purchases, our expansion into organic certification. Now the closest bank is 89 miles away, and they told us they don't make agricultural loans to operations under 5,000 acres. The Thompson family farms 3,200 acres of wheat and barley. Their operation generates $1.2 million in annual revenue and employs 11 seasonal workers during harvest. But they're not large enough for the consolidation-focused banks that have survived the commercial real estate crisis." Translation: family farms that have operated successfully for generations are being eliminated, not by market forces, but by banking sector consolidation that prioritizes large-scale lending over community relationships. Local lending capacity has been eliminated across entire regions. Meridian Trust provided $340 million in small business lending annually across its 9-state footprint. Community development loans, equipment financing, working capital for Main Street businesses that employ fewer than 50 people. That lending infrastructure disappeared overnight. Janet Morrison owns Morrison's Diner in Springdale, Kentucky. Population 4,200. She told the Lexington Herald Leader, "I needed a $15,000 loan to replace our walk-in cooler and update the point-of-sale system. Meridian Trust would have approved it in 3 days because they knew my business, knew my payment history, knew my family. Now the nearest bank requires a 90-page application for any business loan under $50,000. They want 5 years of audited financial statements for a diner that's been profitable for 22 years. Let that sink in. Janet Morrison represents thousands of small business owners discovering that community banking relationships built over decades cannot be replaced by algorithmic underwriting, systems designed for large-scale operations. The human cost extends beyond immediate job losses and business closures. Community infrastructure depends on local banking relationships. The volunteer fire department in Millfield, Ohio, kept its emergency fund at Meridian Trust. Those funds are frozen indefinitely while federal regulators determine asset recovery procedures. The volunteer fire department cannot purchase fuel for their trucks or maintain equipment while their operating funds are inaccessible. High school booster clubs, church building funds, youth sports leagues, community festivals, hundreds of organizations that depended on Meridian Trust for basic financial services are discovering that their ability to serve their communities has been eliminated by decisions made in corporate boardrooms they never knew existed. Too big to fail applies only to institutions that pose systemic risk to major financial centers. Community banks and regional institutions serve communities that major banks consider unprofitable. When regional banks fail, those communities lose access to credit, lose local decision-making authority, lose institutions that understood their specific economic needs. Margaret Chen operated Chen Family Restaurant in Fairview, Montana for 18 years. She told the Billings Gazette, "Meridian Trust approved our loan to expand the dining room in 2019 because they understood our customer base, our seasonal patterns, our role in the community. The big banks see a restaurant in a town of 6,000 people as automatically high risk. They won't even consider applications from rural food service businesses." These are not abstract economic statistics. These are families, businesses, and communities that built relationships with financial institutions over generations. Those relationships provided stability, local decision-making, and credit access that cannot be replicated by automated systems designed for urban markets and large-scale operations. The resilience these communities are showing deserves recognition. Mutual aid networks, informal lending circles, community-supported business initiatives. People are organizing to help each other survive institutional abandonment. But individual resilience cannot replace systemic financial infrastructure. This is not about politics. This is about people whose lives have been destroyed by financial decisions they had no power to influence or prevent. Academic research on financial contagion shows that banking crises follow predictable mathematical patterns. Complexity science modeling from Stanford and MIT demonstrates that when financial institutions hold similar assets and face similar stresses, individual failures trigger automatic cascade effects across the entire network. This isn't psychology, this is network mathematics in action. The Federal Reserve's February 2025 exploratory analysis of systemic risks identified exactly what we're witnessing now. Commercial real estate maturity wall effects, peaking between late 2025 and 2027. Concentrated exposure among regional banks creating multiple failure points. Deposit insurance fund inadequacy relative to total deposits at risk. Translation: federal banking regulators have known for months that this crisis was mathematically inevitable, yet they continued allowing the extend and pretend policies that made it worse. Economic contagion research from complexity modeling shows 3 distinct phases of systemic collapse. Phase 1, isolated failures that appear manageable. Phase 2, correlation discovery, where markets realize multiple institutions face identical risks. Phase 3, cascade acceleration, where failures occur faster than regulatory response capacity. We are currently in Phase 2, approaching Phase 3. The commercial real estate maturity wall represents $1.4 trillion in loans requiring refinancing between now and the end of 2027. Current interest rates make refinancing impossible for approximately 60% of these properties. That means $840 billion in commercial real estate assets will default regardless of economic conditions, management quality, or regulatory intervention. Do the math. $840 billion in certain defaults distributed across a banking system where many institutions have commercial real estate exposure exceeding 400% of their capital base. Insurance system implications extend far beyond deposit insurance. Commercial real estate insurance, business interruption insurance, professional liability insurance for banking executives. The insurance sector faces cascading claims that could destabilize property and casualty insurers simultaneously with banking sector failures. Translation: this crisis has the potential to destroy both banking and insurance infrastructure simultaneously, leaving communities without access to either credit or risk protection. International parallels demonstrate how banking crises spread across developed economies. Sweden's banking crisis of the 1990s, Japan's real estate banking crisis of the early 2000s, Ireland's commercial property banking collapse following the 2008 global crisis. Each followed the same mathematical progression: asset concentration, interest rate shock, cascade failure, economic contraction lasting multiple years. The difference is scale. Previous banking crises affected individual countries. The current commercial real estate exposure exists across banking systems in the United States, Canada, United Kingdom, and European Union simultaneously. Global financial interconnection means cascade effects will transmit internationally faster than individual country responses can contain them. Federal Deposit Insurance Corporation capacity questions become critical when examining total system exposure. The FDIC Insurance Fund contains $128 billion. Total deposits at institutions with high commercial real estate exposure, $4.7 trillion. If 20% of high-risk institutions fail, deposit insurance fund exhaustion occurs within 90 days. What happens after deposit insurance fund exhaustion? Congressional appropriation of taxpayer funds to cover deposit guarantees. Translation: American taxpayers will be required to cover banking sector losses created by executive decisions, prioritizing short-term profits over institutional stability. Warning projection based on mathematical modeling indicates 3 categories of institution vulnerability.